While the world was obsessing over Bitcoin crashes and gold's steady climb, something extraordinary was happening in the shadows of the financial markets, something so powerful that Wall Street veterans are now calling it dangerous territory. I'm talking about silver, the forgotten metal that just pulled off one of the most spectacular rallies in modern history, surging 150% in a single year. But here's what should terrify you or excite you, depending on which side of this trade you're on. Expert analysts are saying this is just the beginning. And if you're sitting on the sidelines right now, you might be making the biggest financial mistake of your life. Let me show you exactly what's happening behind closed doors, why governments are scrambling, and what your next move should be before it's too late. Let's rewind to early 2025. Silver was trading around $30 per ounce, largely ignored by mainstream investors who saw it as gold's boring younger sibling. But something was brewing beneath the surface, something that the smart money had already noticed. For 5 consecutive years, the world had been consuming more silver than it was producing. Think about that for a moment. Every single year since 2021, we've been running a deficit. And by the end of 2025, the accumulated shortage had reached a staggering 900 million ounces. That's not a typo. 900 million ounces of silver that the world needed but couldn't get. Now here's where it gets interesting. Unlike gold, which is primarily used for jewelry and as a store of value, silver has become absolutely critical to modern technology. Over 50% of all silver demand now comes from industrial applications, and we're not talking about optional luxuries here. We're talking about solar panels, electric vehicle components, smartphones, medical equipment, and the entire green energy revolution that every government on Earth has committed to. This isn't speculation, this is cold, hard industrial necessity. But the supply situation is even more precarious than most people realize. Only 28% of global silver comes from primary silver mines, meaning mines that specifically target silver. The other 72% comes as a byproduct of mining other metals like copper, zinc, lead, and gold. This is crucial because it means silver production doesn't respond to price increases the way normal commodities do. You can't just decide to mine more silver. You're dependent on the economics of completely different metals. In 2025, global mine production grew by a measly 2%, reaching about 830 million ounces, while demand was exploding. More than half of this production comes from Latin America, creating massive geopolitical concentration risk that we'll get to in a moment. The base metal operations that produce most of the world's silver aren't optimized for silver extraction, they're optimized for copper or zinc, and silver is just a happy accident. This structural reality means that even as silver prices were doubling and tripling, new supply couldn't flood the market to balance things out. Now let me tell you what happened in late 2024 that set off alarm bells in commodity trading rooms around the world. China, which had been a major exporter of refined silver, suddenly announced a new licensing regime that would take effect January 1st, 2026. On the surface, it looked like typical bureaucratic tightening, but the details revealed something far more strategic. Under the new rules, only companies producing at least 80 tons of silver per year and maintaining a $30 million credit line would be eligible to export. This effectively limited silver exports to just 44 companies in the entire country. Why would China do this? Because they looked at their domestic industries, their massive solar panel manufacturing sector, their booming electric vehicle production, their consumer electronics empire, and they realized something terrifying. They might not have enough silver to feed their own industrial machine. This wasn't about making money from exports. This was about securing critical materials for national industrial strategy. And here's the kicker. Analysts estimate that 60% to 70% of global refined silver supplies could be affected by this decision, because so much of China's silver comes as a byproduct of their massive copper, zinc, and gold processing operations. While China was locking down exports, something even more dramatic was happening in the investment world. In 2025, silver-backed exchange-traded funds saw net inflows of almost 150 million ounces. To put that in perspective, that's nearly 20% of annual global mine production flowing into investment vehicles in a single year. Total ETF holdings surged to 864 million ounces by December 2025, representing a mountain of silver that had been pulled out of industrial circulation and locked away in vaults. These aren't just numbers on a screen. These are actual physical bars of silver sitting in depositories, unavailable for the solar panel manufacturer in Germany or the electronics company in Japan. Every ounce that flows into an ETF is one less ounce available for industry, tightening the physical market even further. And here's what makes this so explosive. ETF investors are notoriously fickle. If prices start falling, they can dump holdings rapidly, flooding the market. But if prices keep rising, they pile in harder, creating a feedback loop that can send prices parabolic. We're currently in the piling in phase, and it's accelerating. Let me paint you a picture of what was happening in the physical silver market in late 2025. London, one of the world's key silver trading hubs, was experiencing actual physical shortages. At the same time, Shanghai was seeing similar tightness, but here's where it gets weird. U.S. inventories were building up. This created unusual arbitrage opportunities, the kind that professional traders dream about, but that also signal severe market dysfunction. Silver that should have been flowing freely between markets was getting stuck due to export restrictions, logistical bottlenecks, and strategic hoarding. The spread between prices in different markets widened to levels that made no sense in an efficiently functioning global market. This is exactly the kind of price volatility and dislocation that precedes major market moves. The smart money saw this and started positioning aggressively, knowing that when these inefficiencies correct, the price moves can be violent and fast. Now let's talk about something that most retail investors have no clue about: state actor involvement. In late 2024, the Russian government announced a plan that should have made headlines everywhere but got buried in the noise of global news. They committed to spending $535 million over 3 years specifically to purchase precious metals, with silver leading the charge. This isn't some minor central bank diversification. This is strategic accumulation at the government level. Russia's Gazprom, their state institution for storing precious metals and stones, has a history of making massive strategic purchases. Back in 2008 and 2009, they bought over $1 billion in rough diamonds. They hold enormous quantities of platinum, palladium, and gold. Now they're going hard after silver. Why? Because they understand what's coming. They see the same supply deficits, the same industrial demand growth, the same geopolitical fractures in the supply chain. And they're not alone. The Saudi Central Bank, one of the most conservative and strategically minded financial institutions in the Middle East, started buying silver ETFs, including the iShares Silver Trust and Global X Silver Miners ETF, with combined holdings exceeding $40 million. When sovereign wealth funds and central banks start accumulating a commodity, you need to pay attention because they have access to analysis and information that retail investors can only dream about. Here's where the story takes a dramatic turn. In November 2025, the U.S. Geological Survey published its updated list of critical minerals, and speculation immediately erupted about whether silver would be designated as critical. This matters enormously because critical mineral designation can trigger Section 232 tariffs, which are national security-based import restrictions. President Donald Trump, who had just been inaugurated in January 2025, issued a proclamation that didn't immediately impose tariffs or quotas on silver, but it did something arguably more significant. It indicated potential future agreements to secure supplies, floated the idea of price floors, and suggested possible levies to support domestic silver producers. Read between the lines here. The U.S. government is signaling that they view silver supply as a national security issue. They're watching China lock down exports. They're seeing the deficit numbers. They're recognizing that American defense industries, tech companies, and green energy manufacturers need reliable silver access. This isn't just about money. This is about strategic resource competition between great powers, and that kind of competition has historically led to explosive commodity price moves. Let me give you some historical context that will blow your mind. There's a metric that precious metals traders watch obsessively called the gold to silver ratio. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Since 1971, when the U.S. went off the gold standard, this ratio has averaged around 60 to 1. Since 2000, it's averaged about 69 to 1. These aren't random numbers, they reflect the relative scarcity and demand dynamics of the two metals over decades. In April 2025, this ratio hit 105 to 1. Let that sink in. It took 105 ounces of silver to buy 1 ounce of gold, meaning silver was historically cheap relative to gold. Experienced traders looked at that number and knew it was unsustainable. Something had to give. Either gold had to crash, or silver had to explode, or some combination of both. What happened next was breathtaking. As silver prices surged through the rest of 2025, that ratio collapsed all the way down to 50 to 1. Silver didn't just catch up to its historical average, it overshot significantly, suggesting that either silver got ahead of itself, or that the structural fundamentals have shifted so dramatically that a new lower ratio is justified. My money is on the latter, and here's why. The industrial demand story for silver is unlike anything we've seen in modern commodity markets. Back in 2015, industrial applications accounted for a decent chunk of silver demand, but it was still primarily seen as a monetary metal and jewelry component. Fast forward to today, and industrial demand has grown 50% and now represents more than half of total consumption. The photovoltaic industry alone, which makes solar panels, has become a massive silver consumer. Each solar panel uses silver paste for its electrical contacts because silver is the most conductive metal we have, and in solar applications, conductivity directly translates to efficiency. As the world races to install solar capacity to meet climate goals, silver demand from this sector is growing exponentially. Yes, manufacturers are desperately trying to reduce the amount of silver per panel. They're experimenting with silver copper pastes, they're researching pure copper substitutes. But here's the reality: alternatives remain limited and often sacrifice performance. You can't just swap out silver without consequences. The electrification trend is equally powerful. Electric vehicles use significantly more silver than internal combustion engine cars because of all the electrical systems, battery management, charging infrastructure, and power electronics. Consumer electronics continue to grow. 5G infrastructure build-out requires silver. Medical applications are expanding. This isn't a temporary demand spike. This is a structural shift in how humanity uses silver. The industrial demand story for silver is unlike anything we've seen in modern commodity markets. Back in 2015, industrial applications accounted for a decent chunk of silver demand, but it was still primarily seen as a monetary metal and jewelry component. Fast forward to today, and industrial demand has grown 50% and now represents more than half of total consumption. The photovoltaic industry alone, which makes solar panels, has become a massive silver consumer. Each solar panel uses silver paste for its electrical contacts because silver is the most conductive metal we have, and in solar applications, conductivity directly translates to efficiency. As the world races to install solar capacity to meet climate goals, silver demand from this sector is growing exponentially. Yes, manufacturers are desperately trying to reduce the amount of silver per panel. They're experimenting with silver copper pastes. They're researching pure copper substitutes. But here's the reality: alternatives remain limited and often sacrifice performance. You can't just swap out silver without consequences. The electrification trend is equally powerful. Electric vehicles use significantly more silver than internal combustion engine cars because of all the electrical systems, battery management, charging infrastructure, and power electronics. Consumer electronics continue to grow. 5G infrastructure build-out requires silver. Medical applications are expanding. This isn't a temporary demand spike. This is a structural shift in how humanity uses silver. Let's talk numbers, because this is where it gets real for your portfolio. Peel Hunt, a well-respected brokerage firm, had been forecasting silver at relatively modest levels, but in January 2026, they completely revised their outlook. They raised their first quarter 2026 silver price estimate by 67% to $75 per ounce. They raised their full year 2026 forecast by 79%, also to $75 per ounce. They set their 2027 projection at $65 per ounce. But most dramatically, they doubled their long-run estimate from $30 per ounce to $50 per ounce. This isn't some fringe newsletter trying to pump a position. This is a major institutional brokerage telling their clients that the fundamental value of silver has permanently repriced higher. When credible analysts double their long-term price targets, you need to understand that something profound has changed in the market structure. They're essentially saying that $50 silver isn't a bubble or a spike, it's the new normal baseline. But wait, it gets even more interesting. Let's look at what actually happened with prices. In the third quarter of 2025, Peel Hunt had forecast an average price of $47.50 per ounce. The actual average came in at $55.10, already 16% above forecast. The quarter closed at $71.70, which was below the all-time high of $79.30 that had been hit during that period, but still represented an extraordinary level. For the full year 2025, silver gained 148%, with only 2 monthly losses in February and April. The fourth quarter alone saw a 53.6% gain. To put this performance in context, silver massively outperformed gold, which was up 11.9%, platinum up 30.3%, palladium up 27.9%, and even Bitcoin, which actually fell 23.6% in 2025. Silver was the standout performer across all major alternative assets. And this wasn't based on hype or social media momentum. It was based on fundamental supply and demand hitting a critical inflection point. Let's talk numbers, because this is where it gets real for your portfolio. Peel Hunt, a well-respected brokerage firm, had been forecasting silver at relatively modest levels, but in January 2026, they completely revised their outlook. They raised their first quarter 2026 silver price estimate by 67% to $75 per ounce. They raised their full year 2026 forecast by 79%, also to $75 per ounce. They set their 2027 projection at $65 per ounce. But most dramatically, they doubled their long-run estimate from $30 per ounce to $50 per ounce. This isn't some fringe newsletter trying to pump a position. This is a major institutional brokerage telling their clients that the fundamental value of silver has permanently repriced higher. When credible analysts double their long-term price targets, you need to understand that something profound has changed in the market structure. They're essentially saying that $50 silver isn't a bubble or a spike, it's the new normal baseline. Now here's where you need to pay very close attention, because this is about your money and your future. By early 2026, spot silver prices had risen almost 30% year to date to more than $93 per ounce. $93. A metal that was $30 just over a year ago. Some people look at that chart and think they missed it, that the easy money has been made. But when you dig into the inflation-adjusted analysis, a completely different picture emerges. Depending on which methodology you use and which historical peak you're measuring from, the inflation-adjusted fair value for silver ranges from $150 to $250 per ounce. Let me repeat that, $150 to $250 per ounce. Silver hit an all-time nominal high of around $50 in 1980 during the Hunt brothers saga. In today's dollars, accounting for 4 decades of inflation, that would be well over $150. The 2011 peak of $49 would be around $70 in today's dollars, which we've already exceeded. But here's the key difference. In 1980 and 2011, silver rallied primarily on investment demand and monetary fear. Today we have that same investment demand, but we also have massive structural industrial demand that didn't exist before. The fundamental case is actually stronger now than it was during those previous peaks. So what does all this mean for you, and what should you do about it? First, understand that we are in the early to middle stages of a supercycle, not the end. The supply deficit is real and growing. Mine production isn't responding fast enough because of the byproduct nature of most silver mining. Industrial demand is accelerating because of unstoppable megatrends like electrification and renewable energy. Governments are recognizing silver as strategically critical and acting to secure supply. Investment flows are still building, not retreating. All of these factors point to sustained higher prices with significant upside potential. But here's the crucial part. Rushed, this market is going to be volatile. Silver always is. Pause. The same factors that drive explosive upside, tight physical markets, concentrated supply, strategic positioning by state actors also create gut-wrenching volatility. You will see 20% corrections. You might see 30% drawdowns. Weak hands will get shaken out. Size. The media will declare the rally over multiple times. This is WWW. Here, fortunes are won and lost, not based on who has the best analysis, but based on who has the conviction and risk management to stay positioned through the volatility. This is where fortunes are won and lost, not based on who has the best analysis, but based on who has the conviction and risk management to stay positioned through the volatility. Here's my strategic framework for how to think about positioning in silver right now. If you have zero exposure, you're making a mistake. The risk reward is simply too compelling to ignore completely. A 5 to 10% portfolio allocation to silver or silver miners is reasonable for most investors who can tolerate volatility. You can get exposure through physical silver, which gives you the security of actual metal, but comes with storage and liquidity considerations. You can use silver ETFs like SLV, which give you paper exposure to silver prices with high liquidity, but counterparty risk. You can buy silver mining stocks, which provide leveraged exposure to silver prices because mining profitability explodes as prices rise, but you also take on company-specific execution risk, jurisdiction risk, and management risk. My personal preference is a barbell approach, core position in physical silver or the most liquid ETFs, and a satellite position in carefully selected mining stocks for asymmetric upside. The miners that survive and thrive in this environment could see 500% to 1,000% gains because they're currently priced for $40, $50 silver, not 100 plus silver. Let me tell you what's happening right now that the mainstream media isn't covering. Professional commodity traders, the kind who manage billions of dollars and have direct relationships with physical metal dealers, are reporting that physical silver is becoming increasingly difficult to source in size. If you want to buy 10,000 ounces, no problem. But if you're trying to acquire 1 million ounces for an industrial application or an institutional position, you're facing delays, premiums above spot price, and in some cases outright inability to source the metal. This is the hallmark of a market that is genuinely tight, not just financially tight on paper, but physically tight in the real world. Refineries are running at capacity. Mints producing silver coins are rationing allocations to dealers. The spreads between paper silver and physical silver are widening. These are all signs that we're in the early stages of a squeeze, and squeezes in commodity markets can produce price moves that seem impossible until they happen. Think about what happened in nickel in 2022, or palladium in 2020, or even oil going negative in 2020. When physical commodity markets break, the price moves can be historic. There's also a generational wealth transfer component to this story that I think is underappreciated. Younger investors, millennials and Gen Z, are waking up to the reality that traditional financial assets like stocks and bonds might not provide the returns their parents enjoyed. They're seeing inflation eroding purchasing power. They're seeing geopolitical instability rising. They're drawn to hard assets, but gold feels expensive at $2,800 per ounce and somewhat inaccessible. Silver at even $90 per ounce is still something you can accumulate meaningfully. $1,000 gets you 11 ounces. $10,000 gets you 110 ounces. This psychological accessibility, combined with social media's ability to spread information rapidly, could drive a retail investment wave into silver similar to what we saw with GameStop or meme stocks, except this time backed by genuine fundamental scarcity. When you combine boomer wealth reallocating into hard assets, sovereign wealth funds accumulating strategically, industrial users scrambling to secure supply, and potentially millions of retail investors discovering silver, you have the makings of a demand tsunami hitting a supply deficit market. Here's the scenario that keeps me up at night in the best possible way from an investor standpoint. Imagine we're 12 months from now, it's early 2027. Silver has continued grinding higher with violent volatility, currently trading around $140 per ounce. The supply deficit has continued for the 7th consecutive year. China's export restrictions have been in place for over a year, and other producing countries are considering similar measures. The US and EU have designated silver as critical and implemented policies to encourage domestic production, but new mines take 7 to 10 years to develop, so no new supply is coming. Industrial demand has grown another 15% as solar installations accelerate and EV adoption crosses a tipping point. Half a dozen silver mining companies have been acquired at massive premiums by strategic buyers or sovereign funds, and retail investment in silver has exploded with ETF holdings up another 200 million ounces. In this scenario, which is entirely plausible based on current trends, anyone who bought silver at $90 in early 2026 has made 55% in a year, while also holding an asset that has real utility and no counterparty risk. That's the opportunity. That's why you can't afford to wait. But let me also give you the bear case because you need to hear both sides to make an informed decision. The bear case goes like this. Silver has already risen 150% in a year and 30% year to date in early 2026. This is a speculative frenzy driven by momentum and FOMO, not fundamentals. Industrial demand growth will slow as high prices incentivize substitution and efficiency. The China export restrictions will be relaxed as diplomatic pressures mount. The supply deficit will close as high prices bring new production online and reduce jewelry and investment demand. ETF investors will panic sell at the first sign of a macro shock, flooding the market with supply. The inflation-adjusted comparisons to 1980 are misleading because market structure has completely changed. And most importantly, silver has disappointed bulls repeatedly over the past decades, making new highs only to crash back down. And this time will be no different. This is a legitimate counter-argument, and some version of this will be what you hear when you tell people you're investing in silver. You need to have conviction about why the structural story is different this time, while remaining humble about the possibility that you're wrong. Position sizing is everything. If you're 50% of your portfolio in silver and the bear case plays out, you're financially destroyed. If you're 5-10% in silver and the bull case plays out, you've dramatically improved your wealth while maintaining diversification if you're wrong. The bottom line is this. We are witnessing a historic repricing of silver from a neglected industrial byproduct to a critical strategic material that is in genuine short supply. The next 12 to 24 months will likely determine whether silver establishes a new trading range in the $100-$150 zone, or whether we see a true blow-off top toward $200 plus, followed by a brutal correction. Either way, having exposure is prudent. Being positioned with the right risk management is critical, and understanding that you're not just trading a commodity, but positioning for a multi-year thematic driven by electrification, deglobalization, and resource nationalism is essential. The opportunity is now. The smart money is already positioned. Governments are scrambling, physical markets are tight, and most importantly, most individual investors still have no idea this is happening. By the time silver is on the cover of every financial magazine and your uncle is asking you how to buy it, the easy money will be gone. You're still early, but that window is closing fast. The question is, will you act, or will you look back in 2 years wishing you had when silver was only at $90? The choice is yours, but the market isn't waiting for anyone.